Welcome to Breaking News at Trading Moves. Today we're looking at a recent earnings report that seemed to cause a definite rotation among software and tech stocks. Our aim is pretty straightforward. Figure out what the headline actually meant, and then look at the specific winners and losers that popped up right after the news. The company right in the spotlight was HubSpot, ticker HUBS. They put out their Q3 earnings, and, on the surface, the numbers for the past quarter looked okay. They even beat expectations technically. But the market reaction wasn't about the past. It was the forward-looking stuff that caused a pretty sudden reaction.
That's right. If you just look backwards, Q3 revenue was up about 21% year over year, around $810 million, and EPS cleared the hurdle. But investors, they're always looking ahead, right? The stock drop really came down to HubSpot's guidance for the coming quarters, specifically their billings.
Billings.
So,
Remind us why that metric is so key here.
sure. Billings basically represent future committed revenue. It's a really crucial indicator of the sales pipeline's health, how many deals are getting signed now for the future. So when HubSpot hinted at slower billings momentum going into Q4 next year, it wasn't about Q3 performance. It was a signal about future growth slowing down. And that signal prompted investors to quickly rethink risk across the whole software-as-a-service SaaS landscape. Oh, and there was another piece of news alongside that, a board change. Clara Shih, who leads business AI at Meta, is joining their board.
Okay, that Clara Shih connection is something we should definitely circle back to when we talk advertising platforms. But first, let's follow the money. If the concern started with future SMB budgets, where did investors move their capital? It seems the first move was towards the big, established players.
Yeah, that was the immediate reaction, a classic rotation towards companies that are maybe more insulated because of their size and contract types. When there's a whiff of slowdown, investors look for stability. Salesforce, ticker CRM, was immediately seen as a safer growth spot.
Why Salesforce specifically? Is it just about being big?
Well, size is part of it, but it's also about who they sell to and how. Salesforce leans heavily on large enterprise deals, multi-year, multi-cloud contracts. That's quite different from relying mostly on smaller businesses where spending can be, turned off more quickly. Enterprise contracts tend to be stickier.
Right. It feels less like selling a tool and more like selling essential plumbing for the business. So ServiceNow, ticker NOW, also benefited. Was that for similar reasons, scale and necessity?
Exactly. ServiceNow gained because investors favored that scale and platform breadth. Their software, things like IT service management or HR workflows, it often gets deeply embedded in a company's operations. It's almost like a utility. So their contracts are seen as less elastic, less likely to be cut compared to, say, tools purely focused on acquiring new customers. When HubSpot's outlook raised flags about SMB demand where budgets can tighten fast, investors move toward platforms like ServiceNow, known for that stability.
Okay, so stability was one theme. But then the market also seemed to favor companies focused on, proving their worth directly, ROI. We saw money moving towards digital ads and core data tools. That tells us where businesses are maybe still willing to spend, even if they're cautious elsewhere.
Yeah, and let's bring back that meta detail now. Clara Shih, joining the HubSpot board, kind of highlighted the role of AI in SMB marketing. Even when smaller businesses face budget pressure, they often don't completely stop spending on performance marketing, the kind where you can track results easily. They tend to focus spending on channels like Google Search or YouTube, platforms run by Google, ticker GODL, and of course, Meta, ticker Meta. These capture existing demand. It's seen more as essential spending to keep the lights on, rather than purely for expansion.
But hang on, if my overall growth is slowing and I'm worried about costs, why would I suddenly spend more on complex data and analytics tools? Wouldn't I cut those too?
That's a good question, and it gets to the heart of the type of spending. When growth via new customer acquisition slows, the focus shifts. It moves from get more customers to get more value out of the customers and spending I already have. And you can't optimize if you don't have visibility. That's where data tools come in. This benefits companies like Snowflake, ticker SNOW, which provides the central data infrastructure, and Datadog, ticker DDOG, which offers observability, seeing how your systems are actually performing.
Ah, okay. So it's not about spending more overall, but shifting spend to tools that help you measure and improve efficiency when every dollar counts.
Precisely. When you're scrutinizing budgets, you need to know what's working and what's not. Snowflake helps centralize the data you need for that, and Datadog tells you about the efficiency of your tech stack. They become critical for cutting waste, which is paramount when growth is harder to come by.
That really clarifies the move from expansion to efficiency focus. Okay, let's look at the other side of the coin. Which stocks got hit the hardest? These presumably reflect those same worries about the SMB market that HubSpot's news triggered.
Right. The group that felt the immediate impact was other SaaS companies heavily focused on SMBs, especially in work management and collaboration. Think about Monday.com, ticker MNDY, and Asana, ticker ASAN. Their fortunes are pretty closely tied to the SMB and mid-market sectors, so they're exposed to the same potential slowdown in adding new users or expanding seats that HubSpot's guidance implied.
So the logic is, if SMBs are slowing down on buying marketing tools, they're probably also slowing down on adding licenses for product management.
That's the read-through the market made, yeah. Investors often extrapolate. If seat expansion slows in one area for SMBs, they assume it might slow in adjacent areas too, especially for tools primarily serving that market segment.
And presumably, if businesses are doing less outreach and trying to acquire fewer new customers, that impacts the tools enabling that activity.
Absolutely. That hits the customer engagement and sales prospecting SaaS providers. Take Twilio, ticker TWLO. A lot of their business is usage-based communication. If overall sales and marketing activity cools down among SMBs, that means fewer messages, fewer calls, potentially lower usage volumes, and then you have tools focused on finding new leads like ZoomInfo, ticker ZI. When budgets get tight and the focus shifts to retaining existing customers, spending on aggressive new logo acquisition tools can face scrutiny and sales cycles might get longer.
Okay, so that covers the direct SMB exposure, but it seemed like some other, maybe higher valued tech stocks also took a hit, even if they aren't purely SMB focused.
Yes, and that brings us to valuation risk, or what's sometimes called multiple compression. When a company like HubSpot, which is often seen as a kind of bellwether for SaaS health, signals slower growth, it can make investors generally more cautious about the whole sector. They start questioning the high valuations placed on other software companies, even if their direct exposure isn't the same. We saw this affect stocks like Okta, ticker OKTA, and DocuSign, ticker DOCU.
So Okta and DocuSign weren't hit because they sell mainly to SMBs, but because the overall sentiment towards high growth, high multiple software cooled off.
Exactly. Their valuations were often based on expectations of continued high, durable growth. HubSpot's guidance acted like a trigger, making the market reassess its tolerance for those premium price-to-sales multiples across the board. If the market starts thinking sector growth overall might be slowing, investors often demand a lower price for each dollar of future revenue, and that particularly impacts stocks that were already trading at high multiples.
So putting this all together, what's the key takeaway for you, the listener? This market movement wasn't just about one company's forecast. It really shows a broader rotation happening, maybe away from spending purely on expansion, that growth at all costs idea, and more towards spending on things that offer measurable results, optimization, and the safety of established, large-scale enterprise providers.
Yeah, the lesson here is how fast signals from one important company in a sector can lead to a pretty rapid reassessment of risk across related areas. The market clearly showed a preference for stability found in large enterprise players, platforms that are hard to switch away from, and tools that promise a direct return on investment. This came at the expense of models heavily reliant on continued SMB expansion. Maybe this leaves you with a question to think about. When budgets get tight, how much does the core utility of a technology like identity management or system observability or performance ads protect it from spending cuts? And conversely, which companies might be too dependent on just broad market expansion to justify their current valuations?
And just a reminder, as always here on Breaking News to Trading Moves, our discussion today is based purely on analyzing market events and news. This is definitely not financial advice and certainly not a recommendation to buy or sell any stocks. It's purely our perspective on the information.